Is the era of American financial supremacy finally coming to an end? For decades, the US dollar's status as the global reserve currency has delivered massive, undeniable benefits to American households, businesses, and policymakers. Foreign central banks, especially those in China and the Gulf states, have historically poured trillions of dollars into the US Treasury market. This insatiable appetite lowered borrowing costs by an estimated 0.5 percentage points, saving American taxpayers billions in mortgage interest and corporate capital costs. But this mechanism, what former Fed Chair Ben Bernanke once called the global savings glut, is unraveling, and it is bringing profound consequences for the U.S. economy. The numbers tell a stark story. Entering the 2000s, the dollar accounted for over 70% of global foreign exchange reserves. Today, that share has slipped below 60%. While that may sound like a modest decline, it reflects a seismic shift in international finance. China's dollar reserves peaked at $4 trillion in 2014. Today, they hover around just $3.3 trillion. Meanwhile, Gulf states have accumulated nearly $800 billion in trade surpluses since 2017, yet their official foreign exchange reserves have barely budged. The petrodollars that once flowed by default into U.S. bonds are now being diverted elsewhere. So, why is confidence fading? The retreat from dollar-denominated assets reflects both geopolitical tension and a loss of faith in American economic management. The U.S. is losing fiscal credibility as public debt climbs relentlessly. Political gridlock constantly threatens government shutdowns, and the White House publicly pressures the Federal Reserve, a move once considered taboo. Furthermore, Washington's willingness to slap tariffs on allies and rivals alike has eroded the predictability of U.S. economic policy. Even more critical is the weaponization of the financial system, the decision to freeze $300 billion in Russian assets following the Ukraine conflict in 2022 sent a shockwave through major reserve holders. It proved that dollar assets can be confiscated for geopolitical reasons, a lesson that Beijing and Gulf capitals have certainly taken to heart. The dollar, once seen as a neutral store of value, is increasingly viewed as a policy tool that can be deployed against anyone who crosses U.S. interests. Even the security agreements that once bound the U.S. to the Gulf are fraying. Recent tensions in the Middle East highlight cracks in the decades-old Energy for Security Pact that turned oil exporters into enthusiastic buyers of U.S. debt. Beyond geopolitics, structural changes in the global economy are fundamentally reducing the demand for dollars. China has moved from a hard peg to the dollar toward a more flexible exchange rate, reducing its need to buy treasuries for currency intervention. Simultaneously, Beijing is aggressively promoting the use of its own currency in international trade. The share of Chinese trade settled in yuan has surged from just 2% in 2010 to 25% in 2023. China's current account surplus has also plummeted from nearly 10% of GDP in 2007 to 2.3% in 2024, leaving less capital available for reinvestment in global markets. In the Gulf, the shift is even more dramatic. Saudi Arabia has transitioned from an international lender to a borrower. As massive domestic projects including over $1 trillion committed to futuristic gigacities and entertainment complexes absorb the petrodollars that used to flow into American bonds. Looking long-term, two major scenarios are shaping the future. First, a gradual decline. Models from the IMF suggest that the dollar's share of Chinese reserves could fall from the current 58% to just 24% by 2050. Second, a rapid decoupling. Geopolitical flashpoints could trigger an accelerated exit, similar to Russia's experience. Moscow slashed the dollar share of its reserves from 40% to 11% in just 5 years between 2016 and 2021. If China were to follow this path, its holdings of U.S. assets could plummet toward zero in a matter of years rather than decades. The fallout for the United States will be severe. The impact won't be limited to financial markets. Higher borrowing costs will make the U.S. national debt an even heavier burden and make domestic investment significantly more expensive. Additionally, Washington's ability to use financial sanctions, a core tool of modern geoeconomic strategy, will diminish as non-dollar payment systems and reserves expand. The era where cheap foreign capital automatically flowed into American assets is drawing to a close. The structural forces that kept the dollar high, kept us borrowing cheap, and made dollar-based sanctions powerful are now reversing. For a nation that has grown accustomed to living with this exorbitant privilege for decades, the adjustment ahead is likely to be anything but comfortable.